Hello everyone and good evening. Today I'm going to present a presentation by the name of Understanding Bond Pricing and Interest Rate Sensitivity in Finance. And this presentation is going to be presented by Mursal Secondary, Westcliff University, and the head of Professor Ricky Lebron, and the course code is FIN 500, Financial Accounting Skills for Minors. A well-known maximum of bond investing is that when interest rates fall, bond prices rise, and vice versa. This is also referred to an interest rate risk, and some bonds are more sensitive to interest rate change than others. The sensitivity is known as a bond duration. Bonds are a vital component of a well-balanced and diversified portfolio. Bonds help preserve principal with low risk and volatility on average than stocks. These fixed income securities generate regular income that may retired investors need, while bonds used to be generally regulated as defensive, lower grade investment compared to a stock. They have increasing pivotal role in growth portfolios, given the generally higher general central bank policy rate globally. Bonds provide income diversification and capital appreciation potential. The bonds with the longer, so in here we have example of overview of bond A and B. The bond with a longer time to maturity will experience a greater percentage price change compared to the bond with a shorter time to maturity. This is because that longer term bond has a longer duration, which measures its sensitivity to change in interest rate. Bond with longer duration will experience larger price change for a given change in interest rate. In here we will consider the bond A and 2 with characteristic. For example, bond A with 3 years maturity, coupon rate of 5%, and bond B a 5-year maturity, coupon rate is 5%. Assuming that current market interest rating is 4%, both bonds would be priced at a value of $100,000. Now let's examine the impact of 1% increase in interest rate. Bond A would experience a longer price decrease with a longer duration, assuming its duration is 15 years. The percentage price change would be approximately minus 15 percentage, and bond B would experience a smaller price decrease with a shorter duration, assuming its duration is 3 years. The percentage price change would be approximately minus 3 percentage. Therefore, bond A would have a higher percentage price change if interest rates go up, reflecting its longer duration and greater sensitivity to interest rate change. Impact of raising interest rates. So what will happen if interest rates go up? Both bonds will experience a decline in the market price. And when interest rate rise, bonds are issued with a higher coupon rate, making existing bonds with a lower rate less appealing. As a result, the pricing of existing bonds must decrease at yield that new market rate. Percentage price change. Which bond has a higher percentage price change? Bond A will have a higher percentage price change decline compared to bond B, about 5 years. Longer duration bonds are more sensitive to interest rate change because they have a longer time turnover, which cash flow must be discounted at the new rate. So assume both bonds have both bonds have a face value of 100,000, which I mentioned before, and a coupon rate of 5. If interest raised by 1 about bond A, we can say the price may drop from 100,000 to approximately 1,800. 1,800. In percentage, we can find a percentage. We will minus 100,000 to 100 from 1,000, and we will divide. Then we will divide 100,000 multiple 200 for finding the percentage. Then it shows minus 20 percentage. And about bond B, we could say that price may drop from 100,000 to approximately 915,000 $15 in percentage change. 915 minus 1,000, and then we will divide 1,000 multiple 200. It shows minus 5 percentage. Investment strategy. So investment strategy, if expecting an economic slowdown, favor shorter duration bond like bond B to minus interest rate risk. Consider high quality corporate or municipal bond that may provide better yield during downturns. Diversify into other asset class like equities and real estate to mitigate risk. And thank you so much. That was all. And I know that it's risky for investing bonds, but it may provide opportunities that maybe find new opportunities to invest and increase our capitality. And this is references which I have used. Thank you.